Hello class, and welcome to the video lecture for Accounting for Merchandise Inventory. Learning Unit 2 is about using a subsidiary ledger for inventory when a business uses a perpetual inventory system. Most businesses that use a perpetual inventory system do not do this manually because, as you will see, it's very complex and easy to make mistakes. Accounting software such as QuickBooks tracks inventory in the same way for you. In fact, when you go to a store and the cashier scans your item into the computer, this is exactly how the computer is recording and tracking the business's reduction in inventory due to your purchase. I've assigned a couple homework problems from this learning unit so you can learn how it works, but I won't ask you to do this on an exam. However, you will have questions about the inventory methods introduced in this learning unit and used in the next learning unit on the quiz and exam. In Accounting 110, you learned about subsidiary ledgers. Subsidiary ledgers are subledgers of general ledger accounts, such as accounts receivable and accounts payable, to track individual sales. The general ledger account itself is called the control account, meaning it always has the total current balance. This same accounting procedure can be used to keep track of inventory. Our merchandise inventory account becomes a control account keeping track of the total balance of inventory, while the details are kept in separate inventory records in a subsidiary ledger for inventory. In the example here, which is also in the textbook on page 557, merchandise inventory account is shown in T account form on the left. On the right, we have the inventory subsidiary ledger for one of the inventory items called AIB software. On June 2nd, 10 software packages were purchased by the business for $25 each. Part of the journal entry to record this transaction includes a debit to merchandise inventory. On June 3rd, the business sold 3 of those packages. Notice it says 3 at 25. That means it sold 3 of the packages it previously purchased for $25, but this has nothing to do with the cost to the customer. Part of the journal entry to record this transaction includes a credit to merchandise inventory. The balance in the column on the right side is the running total of the cost of the inventory. We started with $250 worth of software, and after selling 3, we now have $175 worth of software. On June 5th, a customer returned 1 software package, so we debit merchandise inventory again, and the value of our inventory increases from $175 to $200. Finally, we return 1 software package back to the vendor, which reduces our inventory from $200 to $175. After all these transactions, the balance in our merchandise inventory account is $175. Now we're going to add a new software package to our inventory called R&C software. We purchased 7 of these packages for $225 each. We record this with a debit to merchandise inventory and a credit to accounts payable of $1,575. On June 9th, we sold 2 AIB packages at $50 each, and 3 R&C packages at $295 each, for a total of $985. So this transaction is telling us how much we sold the packages to the customer for, but it doesn't tell us the cost of goods sold. And as you know from Learning Unit 1, we need 2 entries to record this transaction, one to record the sale to the customer, and one to record cost of goods sold. We get the cost of goods sold amount from our inventory records. 2 of the AIB packages cost $25 each, so that's $50, and 3 of the R&C packages cost $225 each, so that's $675. So 50 plus 675 is a total of $725, and that's our cost of goods sold. Presented here on the screen are the 2 journal entries needed for this transaction. You can see now how complex this can get if a business had hundreds or even thousands of individual inventory items. And as I said at the beginning, accounting software and barcodes makes this tracking more simple. Now I'd like to introduce the three most common inventory valuation methods. Valuation means an estimate of its worth or value. For example, what if you sold produce and you purchased 10 heads of lettuce from a farmer for 25 cents each, and another 10 heads of lettuce from a different farmer for 30 cents each. Then you put them out for sale in your store. A customer purchases one, and it's time for you to calculate cost of goods sold so you can record the sale transaction. Does the customer have the head of lettuce that costs 25 cents, or is it the one that costs 30 cents? In some cases, it's simply not practical, like this case, to track individual items like heads of lettuce. Instead, we use valuation methods to make an estimate of the value of inventory at the end of the accounting period. These valuation methods are based on assumptions. An assumption in accounting is when the accountant considers something as fact, even though it might not actually be fact 100% of the time. The first three of these valuation methods is called the average method. The average method means taking the average cost of the goods over a period of time and using that average as a cost per unit. The second of these valuation methods is called first in, first out. Accountants call this FIFO. It means we assume the first good purchased is the first good sold. In the lettuce example, if we used FIFO, we would assume the first head of lettuce sold was one of the heads of lettuce we purchased first for 25 cents. But is that true? We don't really know because the heads of lettuce are all in one big bin. But as long as we use this method consistently all the time, it's an acceptable method of valuing our lettuce. The third of these valuation methods is called last in, first out. Accountants call this LIFO. It means we assume the last good purchased is the first good sold. So in the lettuce example, if we used LIFO, we would assume the first head of lettuce sold was one of the heads of lettuce we purchased for 30 cents, since that was the lettuce we purchased last. Again, we don't know if this is true, but if this is the method of valuation we have chosen, and we use it consistently, it's acceptable. In the next learning objective, you will learn how to calculate cost of goods sold and inventory using each of these three methods.